Hello, in today's video, we'll be taking a look at the Tuesday, April 14th, 2026 trading session for the SPX CBOE index. We'll be utilizing three different indicators for our entries and managing the trades. First is the day trading GPS SPX Daily Key Levels V3.0 indicator for our daily key levels. And then we have our two newest indicators, which we just released yesterday. One is the DT-GPS Vwap for SPX CBOE, and the other is the day trading GPS ribbon indicator with an option for indexes. Okay, so some of you may not be familiar with this problem that exists on TradingView for Vwap on two symbols, one of which is the SPX CBOE, that's the official SPX CBOE index from the CBOE exchange. The other one is the XSP symbol, which is the mini SPX index, which is also on the CBOE exchange. And on those two symbols, if you try to use the native Vwap built into TradingView, whether you're trying to use the auto-anchored one or just the standard Vwap, neither one of them work. And as you can see here, we have, this is the standard Vwap that is on TradingView, so I'll just go ahead and turn off our Vwap for SPX. So as you can see here, the standard Vwap on TradingView does not work. It has this red exclamation point, no volume data. Also, the Vwap auto-anchored native TradingView also does not work, mainly because no volume data. So this is not a TradingView issue. It's not a bug in TradingView. It is simply the fact that the Vwap requires volume data. And unfortunately, CBOE, the data feed from CBOE for those two symbols, SPX CBOE and XSP CBOE, the mini index, do not provide, CBOE does not provide volume data for SPX on that data feed. So consequently, if you try to use a Vwap, native Vwap on TradingView on either one of those SPX symbols, it just simply doesn't work, as you can see here, and then you'll get these red exclamation points. However, our Vwap solution that we came up with, which uses an external source, does work. So I'll go ahead and uncheck those, and we'll go ahead and turn on our Vwap, and as you can see here, our Vwap actually does work. And we'll go ahead and make the line for the Vwap a little bit thicker. So I'll put it on 4 as an example. It automatically detects whether you're on SPX CBOE or XSP SPX mini index and uses an external data source outside of the CBOE data feed to actually provide the Vwap. In addition to the Vwap, we have our new day trading GPS ribbon indicator. So as you may have seen recently, we've also shown some free ribbon indicators that you can use on our recent videos. And the problem with those particular ribbon indicators is when you try to use them on indexes, that at times, depending on how sizable the gap is at the 930 open, either a gap up or gap down, on substantial gap up or gap downs or on extreme ones, the ribbon can be, the normal ribbon can be polluted from the overnight gap because SPX and XSP do not trade in the overnight or in the pre-market. So there's no pre-market or overnight activity like there is, say, with SPY or ES futures. So therefore, when you're trying to use a ribbon indicator on an index such as the Russell 2000, the NASDAQ NDX index, the Dow Jones index, or the SPX index, or the XSP, the mini index, then you will get a situation like this. We'll go ahead and turn off ours, such as the Madrid ribbon, where you have the ribbon is affected by the gap. Now, in this particular case, this is more on the size of a lower medium type of gap, so it may not be as prevalent on this type of gap, but if you get a very sizable gap to an extreme gap, it can really throw off the ribbon and kind of pollute what you're looking at. So, as an example, there's the Madrid ribbon. Our ribbon actually has a filter. So let me turn on that. It has a filter. So if you have the filter off, then you can use it like a regular ribbon, which also means that you can use it on regular symbols that do have overnight and pre-market activity, just like a regular ribbon. However, when you're using on an index, you have this option that you can turn on to enable a filter for US indices, and it resets the ribbon and gives you a completely different look, because then the ribbon is starting from the actual start of the session. Now, the advantage to this is looking at it from the start of the session, you get a completely different picture, which on a lot of days, especially if you have reversals off of the severe gap up or gap down, can come in quite handy, because if you get a reversal on a regular ribbon, it's already distorted from the particular extreme large to extreme substantial gap up or gap down. And the problem there can be is that your entry on the reversal can be quite delayed, because the ribbon's not going to change color until much later on in the session if that reversal trend continues. Whereas if you're using our particular ribbon, then you can get in on the reversal much faster if that reversal happens to happen on a substantial gap up or gap down. The additional advantage of this type of ribbon indicator is that you can do a dual screen. So you can have one screen with the non-filter, with the filter turned off, which would be the regular ribbon, when you're using it on SPX or XSP or another index, and then you could have a side-by-side second one with the filter on. So as an example, here is with the filter on, and this is with the filter off. Same ribbon indicator. So you can have a dual screen look. Not so much prevalent today, but on days that you're getting more of a substantial gap in either direction, up or down, the difference can be quite substantial. So the advantage of this is that in this case, you can actually do a dual screen if you want and see both ribbons, one with the filter on and one with the filter off. So it gives you more flexibility in that respect for when your index has a substantial gap up or gap down. Okay, so let's just go back to the main chart now. Now you combine all of these elements, the daily key levels from the daily key levels indicator, the SPX Vwap, and the ribbon indicator, then you get a true confluence for entries and managing your trades, as opposed to just using one or two of them. As you can see here, this also has the Vwap bands as well. So this is the Vwap here, blue. The reason why the default is blue on the Vwap is to create more of a contrast between this and the yellow thick moving average lines within the moving average ribbon. Normally the Vwap would be yellow, but in order to discern the Vwap better, it's better to create a different color. In this case, we've just gone ahead with the bright blue. Okay, so here, as you can see here, we have the 9:30 a.m. opening BBKPL candle. So whether we're looking at it with the filter on or whether we're looking at it with the ribbon filter off, we're getting a confluence of the ribbon being all green in either situation. That is giving us our confluence of the entry here for the 9:30 a.m. BBKPL alert, bullish alert given by the Daily Key Levels V3.0 indicator. So on this particular trade at the 9:30 a.m. open, a bullish trade, there are 3 different option strikes that you can use. We're only really going to go through one of them today. As you can see, we have the data boxes for just the one, which is the standard play. Now, if you look in the description of this video, you will see links to longer SPX session videos in which we will go into the full strategy, including all 3 option strikes that you can use for any bullish or bearish trade off of any main key level or any contextual key level. The contextual key levels with this indicator are the pre-market high, the pre-market low, yesterday's daily high, yesterday's daily low, and yesterday's daily close. The 3 yesterday's daily high, yesterday's daily low, and yesterday's daily close are from the RTH session. PMH and PML is the pre-market for a high and low for the current session today. The main key levels that you can take bullish or bearish trades off of are going to be the bull bear key price level, the R1 through R6, and the S1 through S6 below. Now, we've zoomed in on just the S2 through R2. That's generally what you want to do at the beginning of the session, mainly because the price action typically in 90 to 95% of the sessions and in the opening moments of the session, if you're the type of trader that likes to take opening candle trades or trades in the first opening moments of the session, are primarily going to be concentrated around the bull bear key price level. However, later on in the session, as price continues to develop and price action can present other trading opportunities off of other key levels as well. For example, close above the pre-market high, taking a bullish entry off of that, or even a bullish entry off of the R1 for a move to R2. Now with the contextual levels, your stop losses, whether it's tight stop loss or standard stop loss, are done through the user control panel. So for example, just to show you that real quick, you go down to the user control panel, you go down to the section for trading, stop loss and take profit levels for the contextual levels, and then you have a bullish entry section and then followed by a bearish entry section below that. And then it lists each one of the contextual levels, and you simply just pick, for example, here the pre-market high. You would enable the bullish entry stop loss for that, and you would pick either standard or tight. And then if you want to use the reward risk multiplier to do your take profit, then you can do it anywhere from the standard default of $2 of reward for each dollar of stop loss risk, or if you want to do less than that, you can go down in 0.25 increments, or you can go above that in 0.25 increments all the way to 30. For stop losses on the main key levels, however, the bull bear key price level, the R1 through R6 and S2 through S6, the tight stop loss and standard stop loss are the other levels that you see here, the midpoint levels and the QL levels above and below, and also the midpoint levels above and below. On a bullish trade from the bull bear key price level, the tight stop loss, if you prefer using tight stop losses, is going to be the QL below the level we're basing the trade off of, in this case BBKPL. So that's QL below BBKPL. If you use a standard stop loss, it's the first midpoint below the level you're basing the bullish trade from. this case mid BBKPL S1. If this was the reverse situation and this was a bearish trade, then off of the BBKPL level, then you would use the QL above for your tight stop loss in a bearish trade from this level, or a first midpoint above for a bearish trade, standard stop loss for a bearish trade from this level. Works the same off the other levels. If you want to turn on the QL levels, you just simply go into the user control panel. The QL above and below the BBKPL are turned on by default. However, you can change the defaults if you want to have other ones naturally turned on if you prefer using tight stop losses. So as you can see, you just have QL line above R1, QL below R1, QL line above R1. You have above and below for each one of the R levels, followed by each one of the S levels. Same thing with the midpoint levels. You just simply turn on which ones that you prefer on the S levels or the R levels. So here in this 9:30 a.m. candle close, the tight stop loss is going to be this level here. Standard stop loss is going to be this level here. As you can see, in either case, neither one was close to being breached. As far as the option strikes, the standard play is going to be the SPX option closest to the level that we're basing the trade on. In this case, we're basing on the bull bear KPL. 69.0807 is today's bull bear KPL level for this session. And so that is going to be the 69.10 call option. You can use either 0-DTE options or 1-DTE options with the Daily Key Levels option trading strategy for SPX. The Daily Key Levels option trading strategy for SPX is bullish entries on closes above any one of the main key levels or contextual key levels. Bearish entries on closes, candle closes below any of the main key levels or 5 contextual levels. The entries are confirmed primarily by the ribbon indicator. So if the ribbon indicator is all green and you have a bullish entry signal, then you're getting confirmation and confluence of the bullish entry. If on the candle close above the main key level or the contextual level, the ribbon is green, then you have the confluence. If the ribbon would happen to be red, or if the ribbon happened to be part green and part red, then there would be no entry on that particular candle, and then you would look to see if one of the succeeding candles, which also closed above and is within range of the acceptable range of the key level in question, and you have the ribbon being all green at that time, then you would have the confluence. Same thing on the reverse. On bearish entries, you're looking for the close below a contextual level or a close below one of the main key levels to be also aligned with the ribbon being all red. Then you have the confluence, and then you have to go ahead on that particular bearish entry. If on the bearish close below a main key level or contextual level, the ribbon is part green and part red, then there would be no trade entry. Consequently, also, if there is a close below a key level or a main contextual level, and the ribbon was all green, then there would be no bearish trade either. So you're looking for confluence where the ribbon is in confluence with the particular close above or close below the main key level or contextual level. Now, if you wanted to be a little more confirmation on your particular entries, then you can also use the Vwap as well. If you want to use all 3 indicators at once, you could also use the Vwap in that respect as well, that on bullish entries, that the close above is also above the Vwap, also with the ribbon indicator being all green, and the same on the reverse. on bearish entries. The close below the key level coincides with also closing below Vwap and the ribbon also being all red. All right, so going on to the trades here for this particular one. The standard play, as I said, is going to be the option strike closest to the level you're basing the trade on, 69.0807. That's going to be the 69.10 call. We're not going over the out of monies one today, but the two out of money ones that you could do on this trade are going to be, you look in the direction of the trade, you go to the first midpoint level in the direction of the trade. In this case, that would be the first midpoint level above the level we're taking the bullish trade from. That's this level here, 69.1969. So your first out of the money option as an alternative to the standard play, if you want to consider a lesser priced option, would be the strike closest to this midpoint, 69.1969. So that would be the 69.20 call. The furthest out of the money, you look one full key level up from the key level you're basing the bullish trade on. In this case, this level, so that would be R1, 69.3130. So that would be the 69.30 call. Works the same way in reverse, works the same way from any key level. Okay, so on the ask on this 9:30 a.m. candle close, we're on a 2-minute chart. The recommended chart time frames for using the daily key level strategy are between the 1-minute time frame up to the 5-minute time frame. With the 2-minute time frame, as you'll see, if you watch our other SPX videos, that's the one that we consistently use. As we have found for our own trading that the 2-minute is the best, most consistent performer. However, if you prefer a different time frame, 1 minute, 2 minute, 3 minute, or 5 minute is fine, just depending on your particular risk profile and the way you like to prefer to trade, and the other indicators which you may also be using that you like to use to confirm entries or manage trades. You may prefer entries and managing trades on a 5-minute time frame as opposed to the 2-minute. So just know that between the 1-minute and 5-minute time frame is fine. However, we have found the 2-minute for SPX for this particular strategy is the best, most consistent performer in our opinion. Okay, so the ask on the candle close of the 9:30 a.m. 2-minute candle, $9.80. So on one call option, these are 0-DTEs, by the way. So this is a 4/14 expiration. As I said earlier, you can use either 0-DTEs or 1-DTEs as you are opening and closing these positions all in the same session. So we do have a video on pros and cons of 0-DTE versus 1-DTE. The 1-DTEs are going to be a little bit better if you're also going to be trading into the latter part of the session, and you don't want to have less volatility on your particular option due to time premium. 0-DTEs are going to lose much more value, say after 1:30, 2 p.m. Versus the 1-DTEs that expire the next trading day. So that's just something that you need to be aware of. If you're doing trades primarily in the first couple of hours of the session and then you're done for the day, if you're primarily just trading in the first couple of hours, closing out all your positions, whether they're wins or losses, say before 11 or 11:30 or even 12, then really the 0-DTEs are going to be much better in most cases than using the 1-DTE. However, if you're the kind of trader that likes to hold your positions throughout the entire session, then you may want to look at 1-DTEs. Okay, so the way that this daily key level strategy works, as I mentioned before, you can look in the description of this video, and there will be longer session videos once we go into the full details of the strategy and much more detail about the indicator, daily key levels indicator itself, so you can take a look at those. Also, we just recently put up a video regarding this ribbon indicator and the Vwap, and that was just put up earlier this week, so you can also look under the selection of videos for that particular video as well if you'd like to see a more in-depth video on those two. All right, so with this indicator and the strategy, there are two different types of trades that you can do. One is a scalp-only trade, and the other is going to be a regular trade. A scalp-only trade, you are looking on SPX to get a one level move in your favor for a exit on a regular scalp trade. How you determine your one level move in your favor is you take the level that you're basing the trade on. In this case, it's bull bear KPL. That you look in the direction of the trade, in this case bullish, so we're looking up. One full level up is R1, that is your scalp only exit for a regular scalp. Here on this candle here, on the 10:14 a.m. candle, we have a hit of the R1 level. Here we have the bid on the candle close, 25.80. So when you purchase this option here, remember that every option you multiply times 100, and that is going to be your cost for one option. So at a cost of $9.80, the ask on the close of this, one of these call options of the 69.10 is going to cost you $980. Here on the 10:14 a.m. bid on the candle close, $25.80. That means the option is now worth $2,580. So that is a profit, a gross profit of $1,600 before any slippage or commissions or options clearing fees. Now with this indicator, you can also do, and we haven't talked about a lot of this before as far as scalps, depending on where the entry is, you can also consider doing micro scalps if there is a contextual level that falls before the one level move in your favor, and that contextual level is far enough away for it to be considered a decent reward to risk. In this case, the PMH is somewhat in that vicinity. If it was more like in this range, like at the midpoint or above, or somewhere between the midpoint and the R1, but that is the only one for today's session that is going to be before the R1 level. So just letting you know that that is an alternative, and that's called a micro scalp. So a micro scalp would be getting out before the one level move in your favor on a contextual level that happens to be in the pathway before you get to the one level move in your favor, as long as that contextual level is sufficiently far away from the entry before you get to the one level move in your favor. Okay, so the other type of trade is going to be what we call a regular trade. A regular trade differs from a scalp in several respects. So one is the amount of movement it has to have. And a regular trade, it needs a minimum 1.5 level move in your favor on a regular trade for you to either exit the trade 100% like you did on the scalp, or for you adjusting the trade, and there's a couple of different options for adjusting the trade. An alternative to that is the 2-level ideal minimum move. The reason it's called the 2-level ideal minimum move is because on about 80% of the sessions that you'll have throughout the year, of which with SPX there's approximately, depending on how the year is with holidays and everything, somewhere between 250 and 255 trading days typically in a year. A lot of times it's about 252 or so. In about 80% of the sessions, most of the price action is going to be between, on SPX at least, between R2 and S2. So 2 levels extension from the bull bear key price level above and below. So what that means is that even if you were entering, say, on a bullish close above. Let's say this went down and it went slightly below S2 and then started going up above S2. You had a confluence of the ribbon and the VWAP, and you had a bullish entry off of S2. Well, then you're playing it back for two-level move, ideal move back to the bull bear KPL, and then anything more than that is gravy. Whereas the minimum 1.5 move would be to be mid BBKPL S1. On a move from the bull bear key price level, the mid R1, R2 on a bullish trade from this level is the 1.5 level move in your favor. Remember, this is the full regular scalp here, the 1 level move. And the R2 would be a 2 level move on a bullish one. On the reverse here, let's say if we had a completely red ribbon, a close below R2, and if you also wanted to add a third confirmation if it was also closing below VWAP. You don't have to use all three, the VWAP and the ribbon as well. You could use, if you're going to just use two, then we recommend using the ribbon on top of the daily key levels indicator. If you want to use all three for your confirmations, then you could also add the VWAP on top of that. The VWAP in general is good to have on your chart just as a general context to be aware of where the VWAP is and the VWAP bands. So whether you're using the VWAP or not, it is still good to have the VWAP on your chart. However, for the confirmations, we're primarily looking for completely red ribbon with a close below a main or contextual key level, or a completely green ribbon with a close above a main or contextual key level. So the point was, conversely, if you had a red ribbon here, let's say this was all red, which obviously it's not at the moment, it's part red and part green. So on a close below here, there would be no, at the moment, if we got a close below here, there would be no bearish trade because we have a just partially red ribbon. And it's partially green and partially red. But if we did, and there was a close below R2, then a two-level move would be back to the bull bear key price level. That would be the minimum ideal move. 1.5 level move in your favor down to this level here. Okay, so on this 11:20 a.m. candle, we have a hit of the mid R1, R2. That is going to be your 1.5 level move in your favor. Now this candle right before it, 11:18, you can see there is quite a difference between what you're getting on that and what you're getting once it finally hits. So you may be tempted. It's still up to each individual trader to decide when to get out. However, we still recommend that you do get out once you have a hit of the actual 1.5 level move in your favor. So as you can see, when it's approaching here, it still is up quite a bit. However, there is almost a $300 difference between this candle and this candle here where it actually does hit. So just wanted to point that out. We've had some people ask us about, do you have to wait until the actual 1.5 level move, or can you just treat it as a zone? You can treat it as a zone if you want. So if it's just approaching, that's completely up to each individual trader to decide for themselves. But we recommend, in our opinion, it's better to wait to the actual hit of the 1.5 level move. But again, that's up to each individual trader to decide for themselves. So at the hit here of the 11:20 a.m. candle, then you have 34.80 as the bid on the candle close. Another thing to keep in mind is that you can either get out on the actual touch of the level. So when SPX actually trades at that level intra-candle, you could get out. And you could also do the same thing on your scalps. So that's one way of doing it. The other way of doing it is just getting out, or doing, in this case, getting out or doing an adjustment on the candle close of the 1.5 level move in your favor, or on the case of the scalp, candle close on the candle that actually hits the R1. So it really just depends on each individual trader. It's best to try to be consistent. So if you decide that you prefer the method of just getting out on the touch of the level when that happens, whether it's intercandle or when it does happen, uh, or to get out on candle closes. So some people, it's easier for them just to do it on candle closes. They know, if they're on a certain chart time frame that when that candle close is going to occur. You can also, with TradingView, have a candle close countdown thing, which we don't have currently on this chart right now, but in TradingView, you do have that option where you can uh, turn on the remaining time to candle close thing, and it'll show you a countdown. So it really just depends on your preference. So at that 11:20 a.m. candle close, 34.80 bid, that is now a profit of 2,500 before any commissions, clearing fees, or any possible slippage. 980 to 34.80, 2,500. Here on the 11:44 a.m. candle, we have the hit and close at the R2 level. Now 44.70 on the bid on that candle close. That's going to be a profit of $3,490, and that is your minimum ideal 2-level move. Now, going back to the 1.5 level move in your favor, what are the other options besides just exiting? So it really comes down to how many options that you have. That's one consideration. And then what you're looking to do. So the options are A, you can just do what you did on the scalp, 100% exit all of your contracts, whether you're trading 1, 2, 3, 5, 10, 20, or what have you. The other option, if you don't want to do that, is you can adjust your stop loss to break even or break even plus a minimum profit buffer of say 10 to 15% on top of break even. Break even when you're adjusting is not moving your stop loss to the level that you took the trade from. So in this case, that would not be moving the stop loss to the bull bear key price level. Your entry stop loss is going to be level based. However, when you're doing a stop loss adjustment to break even or break even plus a profit buffer, then at that time you are switching on a regular trade to adjusting it to the price that you actually executed your entry at. Entry executed at $9.80, then break even would be adjusting your stop loss when it hits the mid R1, R2 minimum 1.5 level threshold to $9.80. Now, if you wanted to add a 10% profit buffer, that would roughly be adding $1. That would be $10.80. 15% would be adding 15% to it, like $1.50. That would be like $11.30. You're trying to not add too much of a profit buffer at the beginning because you don't really know in any given session how far up is this going to turn out to be a day where it goes up 3 or 4 levels instead of the typical 80% of the sessions where it's going to be a 2-level move extension from the BBKPL. So it's hard to really discern at the beginning of or during a session because news can come out, especially with the current presidential administration that we have and the current environment we have with the war going on and gas prices and oil prices and everything that's in flux with that right now, you can have stuff that can come out where we could get huge jumps in the market in either direction based on news flashes coming out. And just in general, like I said, that's 80% of the time 2-level moves. 20% of the time you're going to have more than 2-level moves. Okay, so that would be keeping all of your options and adjusting your stop loss to break even or break even plus the profit buffer. So that would be your second thing that you could do. Your third thing that you can do is to start scaling out your trade and adjust your stop loss and remaining runners, and then basically manage your remaining runners for additional key levels in your favor. That would entail, if that option would be open to you if you're trading 3 or more options, because under that strategy, you are closing out and exiting at least 60 to 65% of your initial position up to 90% of your original position, and then on the remaining leftover position, the remaining runner position, then you are adjusting your stop loss to at least break even on that. Then you're trying to manage the remaining runner position as price continues to move in your favor to additional key levels. At that point, what does additional key levels mean as far as managing your trade? That means any midpoint level, any main key level, or any contextual level that happens to fall in the pathway after the 1.5 level move in your favor. So in this case, there's no contextual levels that happen to fall in the path after this 1.5 level move on this bullish trade. So it would just be hitting from this being the 1.5 level move, R2, then mid R2, R3, then R3, and then the levels above that if we had mid R3, R4 turned on, etc. Then at each additional key level move in your favor past the 1.5 level move, then you can either take off and exit some of your remaining runners, further adjust your stop loss on the remaining runners, or a combination of doing those two. If you're only trading one option from the beginning in your initial entry position, then you really just have two options. One is either exiting your one option at the 1.5 level move in your favor, or the minimum ideal 2 level move in your favor, or adjusting your stop loss at either one. So the third alternative we talked about is really going to apply if you are trading 3 or more options as your initial position. Okay, so in the 1144, this candle here, 44.70 bid on the candle close, profit $3,490 per option, and that's obviously going to be before any possible slippage, commissions that you may pay to your broker, and also any option clearing fees. Now, this indicator also works on the XSP symbol as well, which is the SPX mini index. So if you're more inclined to trade the XSP, you can also trade that with the SPX Daily Key Levels indicator. The ribbon is going to work the same way for that index as well, having the filter to either be on or off. And the DT GPS Vwap also works on the XSP symbol as well. One advantage to XSP options is that if you have an account size where you can normally trade one regular SPX option, XSP trades at 1/10 the value of the regular SPX index. So consequently, the XSP options trade at approximately 1/10. So theoretically, you can trade 10 XSP options for roughly the same price as one regular SPX index options. So if you would like more of the flexibility of trading with 10 options, you may just want to look at using XSP. That way, when you get to the 1.5 level move in your favor, if you prefer regular trades over doing scalp trades, then you can have the option of selling anywhere from 6 of those 10 up to 9 of those 10, so anywhere between 60 and 90%, and then having the remaining runners to manage. Okay, so that's going to wrap it up for this video. If you are interested in purchasing this indicator, you may have seen that we did put out two videos earlier this week on a special sale that we had starting earlier this week that ends tomorrow, end of day tomorrow, 4/15/26. So today and tomorrow, today's the 14th, today and tomorrow is the last day of that sale. That sale is that you can use a promo code through the end of day April 15th to get the SPX Daily Key Levels Indicator by using that promo code at a price of $499 for lifetime access. That price is not going to be lower anytime this year. This was a special sale that we decided to do for this time of the year. Normally, the savings is not going to be near that amount when we do other promo codes. So if you are inclined to purchase the indicator, then I would highly suggest that you do it either today or tomorrow, as after that it will be more expensive, as the promo code will be less significant than the discount currently. Also, we have a special sale on our daily key level suite, which includes all 5 of our daily key levels indicators. And that suite with the promo code, if you look at that video that was posted earlier this week, is for a savings of over $1,100 on that suite. So that is going to be $875 for all 5 daily key levels indicators for lifetime access. So on that note, if you want to look in the description of this video, there will be links to those 2 special sale videos that we posted earlier this week along with the promo codes. And if you do want to take advantage of either one of those, then please do so either today or by end of day tomorrow, as that is when it ends. Okay, so you may be wondering, well, how do the daily key levels indicators, how have they been working for people that have already purchased them and used them every day in the trading? So what we'd like to do now is show you some of the feedback and reviews that we've received on the daily key levels indicators. All of this feedback and reviews is available to be seen at our Vwap.com links for purchasing any of the indicators. You simply click on those. You can look at the reviews themselves, but we're just going to go ahead and show you screenshots of them now. Alright, that's going to wrap up this video. If you did like this video, we'd appreciate it if you would please hit the like button, as that helps us with the YouTube algorithm and helps support the channel, so we'd appreciate that. If you want to be notified of when we post new videos on any trade topic, including any session videos on any of our daily key levels indicators, or for other videos on other trade topics, please subscribe, and then you'll be to our YouTube channel, and then you'll be notified when we post any new videos automatically. So thank you again for taking your time for watching this video today, and we wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.